In early 2020, a global travel platform built on constant movement suddenly faced a world where movement stopped completely, and that instantly shut down its core demand. By 1919, Airbnb had scaled to millions of listings across more than 190 countries, which meant its entire revenue system depended on people continuing to travel. Then, within weeks, the COVID-19 pandemic triggered border closures, grounded flights, and locked cities, which caused bookings to collapse almost overnight. Future reservations that once represented guaranteed revenue turned into mass cancellations, and that forced the platform into a conflict between both sides. Airbnb did not own properties and did not employ hosts, which meant it had no direct control over either supply or demand, as both started breaking simultaneously. What had once made the company powerful, its asset-light model, now exposed a critical weakness because there was no buffer to absorb the shock. Revenue dropped sharply within weeks, and that revealed how quickly a global growth system could destabilize when its core assumption failed. This was no longer a growth story, but a system under sudden pressure, where survival depended on how fast the model could adapt. Before the shock, Airbnb had built one of the fastest-growing travel platforms in the world, and that growth was driven by a model that required almost no physical assets. Instead of owning properties, the company relied on millions of independent hosts, which allowed it to expand globally without the capital constraints faced by hotels. By 2019, listings had spread across more than 190 countries, and that scale meant the platform's revenue was directly tied to continuous booking activity. Each new host increased available supply, which attracted more guests, and this created a reinforcing loop that accelerated growth year after year. The platform earned fees on every transaction, which meant more travel directly translated into higher revenue without increasing operational burden. This structure made the business highly efficient during expansion, but it also concentrated risk into a single behavior: people moving between locations. There was no meaningful diversification beyond travel demand, which meant the system had no alternative revenue stream if movement slowed. As long as flights operated and cities remained open, the model scaled rapidly, and this reinforced confidence in its long-term stability. But that same dependence meant when global movement stopped, the entire system would face pressure at once, rather than gradually. At its core, Airbnb operated as a two-sided marketplace where value depended on balancing hosts providing space and guests demanding it. The platform did not control pricing directly, which meant supply and demand determined outcomes, and this created flexibility but reduced stability. Hosts could enter or leave at any time, which allowed rapid scaling, but it also meant supply could disappear just as quickly under pressure. Guests booked based on trust in the platform, which required consistent availability and predictable travel conditions to sustain demand. Airbnb positioned itself as an intermediary, taking a percentage from each booking, which meant it earned only when transactions occurred. This structure minimized fixed costs, but it also removed any internal buffer because revenue stopped the moment bookings declined. Unlike hotels, the company had no owned inventory to optimize or hold value during downturns, which increased exposure to external shocks. The entire system depended on coordination between independent actors, and this made it efficient during growth but fragile during disruption. When both sides of the marketplace reacted to the same global event, the model had no mechanism to stabilize itself internally. By 2019, Airbnb was facilitating hundreds of millions of guest arrivals annually, and this volume turned the platform into a major global travel intermediary. The company generated over $4.8 billion in revenue in 2019, which showed how tightly its earnings were linked to booking activity. Urban tourism, short-term stays, and cross-border travel drove the majority of demand, which meant the model depended heavily on open borders and active cities. Major destinations like New York, Paris, and London became high-density revenue hubs, and this concentrated income into travel-heavy regions. Airbnb Experiences was introduced to expand revenue streams, but it remained a small portion compared to core accommodation bookings. The fee-based model delivered strong margins during growth, but it required constant transaction flow to sustain those margins. Seasonality already created fluctuations, which meant the system had limited tolerance for prolonged disruptions even before 2020. Despite this, investor confidence remained high, and the company was preparing for a public listing based on continued expansion assumptions. That expectation was built on uninterrupted global travel, and once that assumption failed, the growth engine lost its foundation almost immediately. Beneath the rapid growth, the model carried a structural weakness where revenue could disappear immediately if bookings stopped. Unlike traditional hotel chains, Airbnb had no owned assets to stabilize income, which meant there was no fallback when demand declined. Hosts were independent and financially exposed, which meant their participation depended entirely on continued guest bookings. When occupancy dropped, hosts faced immediate income loss, and this created pressure on the supply side to exit or reduce availability. At the same time, Airbnb still carried fixed operating costs, including marketing, platform infrastructure, and a workforce of thousands of employees. This created a mismatch where costs remained while revenue depended on real-time transactions that could vanish quickly. Short-term cancellations had always existed, but the system had never been tested against a simultaneous global shutdown. Refund obligations added another layer of risk because future revenue was tied to bookings that could be reversed instantly. These weaknesses remained hidden during expansion, but they positioned the system for a rapid breakdown once external conditions shifted. In March 2020, global travel restrictions were implemented at scale, and this immediately disrupted the flow of bookings across the platform. Within weeks, Airbnb experienced a surge of cancellations as guests withdrew from upcoming trips, which erased expected revenue almost instantly. The company introduced a broad refund policy covering pandemic-related cancellations, and this shifted financial pressure directly onto hosts. Hosts who depended on bookings for income suddenly faced zero cash flow, while still managing property costs like rent and mortgages. At the same time, guests demanded full refunds, which forced Airbnb into a position where it had to balance trust between both sides. This decision triggered backlash from hosts who felt the platform had overridden their individual cancellation policies without compensation. The platform's role as an intermediary became a point of conflict because it had to absorb reputational risk without full control over outcomes. Revenue declined sharply during this period, with estimates indicating an approximate 80% drop in booking activity. What had been a steady transaction flow turned into a system-wide disruption where both demand and supply reacted negatively at the same time. As bookings collapsed, Airbnb moved quickly to preserve cash, and this led to immediate cost-cutting measures across the company. In May 2020, the company laid off about 1,900 employees, roughly 25% of its workforce, which reflected the severity of the revenue shock. Marketing spend was sharply reduced, and this slowed customer acquisition, which further limited short-term recovery potential. To stabilize operations, Airbnb raised $2 billion in emergency funding through debt and equity, but this came at a significantly higher cost of capital. The company also paused non-core initiatives, including scaling back Airbnb experiences, to focus on its primary accommodation business. At the same time, it introduced support programs for hosts, including a $250 million fund to partially compensate cancellations, which aimed to rebuild trust. Travel demand began shifting toward local and longer-term stays, and Airbnb adjusted its platform to capture this emerging behavior. Despite these adjustments, revenue for 2020 fell to around $3.4 billion from $4.8 billion in 1919, confirming the depth of the disruption. The model did not collapse entirely, but it underwent a forced reset where survival depended on rapid adaptation rather than continued expansion. The events of 2020 revealed that an asset-light platform can scale rapidly, but it also means risk is transferred rather than eliminated. Airbnb did not carry the cost of owning properties, but it also lacked control when both supply and demand failed at the same time. The model depended on external systems like global travel, aviation, and open borders, which meant it was exposed to shocks beyond its control. When those systems stopped, revenue did not decline gradually, it collapsed immediately, because transactions were the only income source. This highlighted a key trade-off between efficiency and resilience, where maximizing growth reduced the ability to absorb disruption. The conflict between hosts and guests showed that platform trust becomes fragile when incentives are not aligned during crisis conditions. Airbnb's survival depended on adapting its model toward domestic travel and longer stays, which reduced reliance on international movement. The recovery demonstrated that flexibility could stabilize the system, but only after significant operational and financial pressure. This case showed that platform businesses can grow faster than traditional models, but when their core assumption fails, they can break just as quickly.